Hi, I am Sylvia of CPD Box, and I've been posting IFRS lectures for many years. Consolidation is one of the more complex topics, and I published several lectures about it. So in this masterclass, I combine them all, arrange them in a logical order, so you don't have to go and search all over the place. Here, you're just on the best way to get a solid starting point.
But if you want to learn more in depth and become really advanced, then I invite you sincerely to check the IFRS kit. There are many more advanced lectures, not only on consolidation, but other topics. They are not publicly available, so if you're serious about learning IFRS, then maybe this would be a great resource for you. Now back to our masterclass. We will start with the introduction to consolidation and group accounts under IFRS. Enjoy! Group accounting is a hot accounting topic because there are many mergers and holding formations. So in this video, we will introduce the 6 IFRS accounting standards related to groups. I will guide you through basic definitions of individual members of those groups. And finally, we will see the overview of different types of investments, how they tie to the IFRS accounting standards. In fact, there are 6 standards, as I have mentioned, dealing with investments or consolidation in total. The first one is IAS 27. Separate financial statements, and this standard prescribes how the investor or a parent company or a holding company shall present its investments in the individual or separate financial statements. So basically in one line only. So this standard is not about consolidating, just telling us how should we show our investments in the separate financial statements. The second one is IAS 28, investments in associates and joint ventures. We'll define them a little bit later. So this standard prescribes how to account for these types of investments and defines and describes the equity method of accounting. The third standard is IFRS 3, business combinations. And this one is really important because it defines what the business combination is and how we shall identify one. And then also it says the recognition and measurement principles of how the acquirer or investor shall treat the goodwill, non-controlling interest, and identifiable assets and liabilities that you acquire in business combination. So IFRS 3 does not describe the consolidation procedures, but it does describe and define the basics for the consolidation, like goodwill, non-controlling interest, and so on. IFRS 10, Consolidated Financial Statements, is the standard that is directly related to IFRS 3 because it defines control, what it is, when the acquirer exercises the control over its acquiree or investment, and then it requires a parent or an investor to present consolidated financial statements. It establishes the consolidation procedures that the investor must follow when preparing those statements, and among other things sets some exceptions. For example, investment entities that don't need to prepare the consolidated financial statements. And then we have IFRS 11, joint arrangements, and this standard deals with the activities jointly executed by the parties, and there are 2 types of them, joint ventures and joint operations, and IFRS 11 defines them both and prescribes the accounting treatment for both of them. Finally, there's the standard IFRS 12, disclosure of interests in other entities, and as its title says, it simply prescribes all necessary information that you need to disclose about subsidiaries, associates, joint arrangements, and other entities too. Now, as we're familiar with the IFRS accounting standards that arrange those consolidation issues, let me bring some light into different types of investments and set their basic definitions, or members of the group, I would say. First, we have an investor who acquires some shares, and this is called parent or a holding company. IFRS 10 defines parent as an entity that controls one or more subsidiaries. Note the word controls. I will mention it very often throughout this video because if a parent controls some entity, then the accounting treatment is totally different from the situation without control. So imagine this parent purchases more than 50% share capital of some other company and is able to control it. Then the investment is called subsidiary. And IFRS 10 defines a subsidiary as an entity that is controlled by another entity. Again, note the word controlled. So when we put that all together, we have a group which is defined as a parent and all its subsidiaries. Now, investor can purchase less than 50% share, for example, when it acquires more than 20% and is able to exercise significant influence in the investment, then that investment is an associate, not a subsidiary, associate. IAS 28 defines associate as an entity over which an investor has significant influence and which is neither subsidiary nor an interest in joint venture. Also, there can be another way of investing and doing business together, which is having joint control with some other entity of some business or assets and liabilities. This is called joint arrangement. And the standard IFRS 11 defines it as arrangement of which two or more parties have joint control. That's all in IFRS 11. So now let's sum up the differences between individual types of investments here so that you can make a clear distinction and you know what we're talking about. So as we have defined, we'll talk about subsidiaries, associates, and joint arrangement. That can be both joint ventures and joint operations. The basic criteria that make a difference between these types is the amount of power that investor exercises in the investment. When we talk about subsidiary, there's control. So the investor has the ability to exercise control of subsidiary. The indicator here is the share of investor or a parent on the equity of a subsidiary is more than 50%. Well, that's just the indicator because there are some entities without any share and they can still meet the definition of a subsidiary, for example, some special purpose entities. So when there's control, a parent company must apply an acquisition method of accounting when the subsidiary is purchased and full consolidation method for the preparation of the financial statements. Opposed to that, when we talk about the associate, then the investor does not have ability to exercise control, only significant influence, and this is the power to participate but not to control. An indicator of existence of significant influence is that investor holds 20% or more of the voting power or voting rights of the investee. If it has less, then there's probably no significant influence, but this is just indicator. In this situation, investor applies equity method of accounting for an associate. And then there are joint arrangements, and these are a bit different because there's joint control of two or more parties of some business or operation. And because of the control is joint, it makes no sense to specify the amount of share. It can be 50 when there are two parties or 33% when there are three parties, etc. Method of accounting for joint arrangement depends on the type of joint arrangement because there could be joint ventures. In that case, you'll apply equity method or joint operations. And here, investor accounts for its share on assets, liabilities, revenues, and expenses on the joint operation. And then there are other investments that don't fall into any above category, and these are simply financial instruments accounted for in line with IFRS 9. All right, after this short introduction, let's dive a bit more into the standard IFRS 3 business combinations. So I would say that IFRS 3 and IFRS 10 complement each other because both of them deal with the parent-subsidiary relationship. They just look at different aspects of it. So what's IFRS 3 about? The objective of IFRS 3 is to improve the quality of the information that the reporting entity gives in its financial statements about business combination and its effects. So more specifically, IFRS 3 sets principles and requirements for how an investor or a parent or an acquirer should recognize and measure the assets acquired, the liabilities assumed, and any non-controlling interest in the subsidiary. And then how the investor should recognize and measure the goodwill acquired in the business combination or a gain from a bargain purchase, and we will explain that a little bit later. And also how to determine what information to show about the business combination. So IFRS 3 is not about consolidation procedure. It does not tell you how to prepare consolidated financial statements. So if you need to know that, look at IFRS 10 consolidated financial statements. Now, before you start account for a business combination or for a group, assets and liabilities that the investor acquires need to constitute a business, because in a different case, it's not a business combination and an investor needs to account for the transaction in line with other IFRS. What's the problem here? Well, sometimes investor acquires only a part of some company, for example, just a production plant or a factory. So is that an asset? Or is it a business that you acquire? When you acquire another company, that's not a problem to determine. But in some cases, when not whole company is acquired, we really need to assess whether we acquire a business or not. And IFRS 3 gives you the guidance, and it says that the business can be acquired in many different ways, and it needs to contain 3 basic elements, which are inputs. And these are sort of economic resources that create or can create outputs when one or more processes are applied to it. For example, non-current assets, inventories, or cash. These are all inputs. Then the element number 2 are processes, so some systems, standard, protocols, rules. And these are all the things that you apply to inputs, and in the combination, these create outputs. So some management processes, workforce, production processes are the example of this element number 2. And finally, the outputs. And outputs are results of inputs and processes combined, all right? So these could be, for example, some returns in the form of dividends, lower costs, or other economic benefits. So if all 3 elements are here present, then an investor acquired a business and needs to apply IFRS 3 for business combinations. Otherwise, investor might acquire just assets and apply own processes. And in this case, investor does not account in line with IFRS 3, but in line with some other standard applicable for the acquired assets, like IAS 16, for example. Now, it was quite challenging in some cases to determine whether the investor acquired a business or just assets and liabilities. So IFRS 3 was later amended and the guidance was added. For example, IFRS 3 introduced so-called concentration test. And this is a simplified assessment of business or assets dilemma, and it basically asks you to assess whether substantially all of the fair value of acquired assets relates to one asset or a group of similar assets. If the test is met, then you acquired assets, not a business, and vice versa. This test is optional though. You do not have to apply it. It is here to help you when you need it. And as I have said already, in most cases, the acquisition is clear and straightforward. Now, how to account for a business combination under IFRS 3? You should apply the acquisition method that involves 4 steps. Step number 1, identify the acquirer or the buyer. I know it looks straightforward, and in many cases it is, but sometimes it's not so clear. For example, you can deal with some merger or when 2 companies merge together. And in this case, you need to identify who acquires who. And in most cases, it will be the larger company. Or reverse acquisitions may make confusion too. It's when smaller company buys bigger company. Step number 2, determine the acquisition date. And it's the date on which the parent acquires control over subsidiary and starts applying acquisition method. In most cases, it's the closing date, but it can be earlier or later. Step number 3, recognize and measure the identifiable assets acquired, the liabilities assumed, and any non-controlling interest in the acquiree. And step number 4, recognize and measure goodwill or a gain from a bargain purchase. And we'll spend a little more time on steps number 3 and 4. So let's take a closer look at step number 3. Recognize and measure the identifiable assets acquired, the liabilities assumed, and any non-controlling interest in the acquiree. An investor shall recognize all identifiable assets and liabilities and non-controlling interest separately from goodwill. And the important thing here is to recognize it at fair values determined at the acquisition date. Subsidiary can apply different measurement methods, for example, cost less depreciation, and as a result, often fair value adjustments are necessary at consolidation. Sometimes subsidiary also can have some unrecognized assets or liabilities, and these need to be recognized too. What about non-controlling interest? So that's the equity in a subsidiary that is not attributable to a parent. So it's a part of a subsidiary that belongs to someone else, right? Just as an example, if a parent owns 100% share in a subsidiary, then non-controlling interest is 0 because full subsidiary's equity is owned by the parent. But if parent owns less than 100% share, let's say 80%, then non-controlling interest is 20%. A few years ago, that was called minority interest. And there are 2 options or methods permitted by IFRS 3 to deal with non-controlling interest. Method number 1, you can measure non-controlling interest at the proportionate share of non-controlling interest on the fair value of the subsidiary's net assets. Or method number 2, we can measure it at its full or fair value, usually based on market value of the shares held by the non-controlling interest. That's more usual for publicly traded entities. Method number 2 affects goodwill, by the way, because under fair value method, you're showing that non-controlling interest owns a part of that goodwill too. So if you'd like to revise the short illustrative example with numbers, please refer to IFRS 3 article on cpdbox.com or subscribe to our courses in which you'll find a lot of related calculations and explanations. Step number 4, recognize and measure goodwill or a gain from a bargain purchase. Goodwill is an asset representing future economic benefits arising from other assets acquired in a business combination that are not individually identified and separately recognized. So let's imagine a parent buys 100% shares in a subsidiary. Parent pays 100,000 currency units for these shares in cash, and at the date of purchase or acquisition, subsidiary's net assets or equity was 80,000 currency units. So here we have a difference of 20,000 currency units, and this difference is nothing else than goodwill. There are many more issues to watch out when calculating goodwill, so please take this as a simplified version. So let me lead you through the formula. The goodwill is the excess of the aggregate or the total of the sum of the consideration transferred, which is usually acquisition date fair values of that consideration, so what parent pays for a subsidiary for that share, then the amount of any non-controlling interest in the acquiree measured in accordance with this IFRS, and finally, if the business combination was achieved in stages, so first you bought 20%, then you bought another 40%, we need to add the acquisition date fair value of the previously held equity interest in the acquirer. So in our small example, the aggregate is 100,000 currency units. On the other hand, we need to look at the net of the acquisition date amounts of the identifiable assets acquired less liabilities assumed. So in this case, it's 80,000. That's net assets basically. Sometimes the goodwill is positive and sometimes it's negative. And the basic goodwill formula is the fair value of the consideration transferred plus non-controlling interest plus add the previously held interest if subsidiary is acquired in stages and deduct the subsidiary's net assets. Now, the result can be either positive or negative. So if the result is positive or greater than 0, then the difference is called goodwill. And it's acquired in a business combination and a parent needs to capitalize it as an intangible asset and perform annual impairment review. So no amortization of goodwill. That's obsolete. But if the difference is less than 0 or negative, then it means that the parent paid lower amount for the subsidiary than its fair value is. Some people call it badwill or a gain on a bargain purchase. It's a negative goodwill, in fact. So first of all, what you will do is to reassess the amounts at which the parent measured both the cost of the combination and subsidiaries net assets. So look at your formula once again because there might be some error. And the parent needs to make sure that there is really a negative goodwill because it's very unusual to buy something at a bargain, right? Secondly, if everything is okay, then we need to recognize any excess or negative goodwill in profit or loss immediately. So we are not going to treat it like some liability. We are just recognizing the profit in profit or loss. Except for these basic rules covered in this video, IFRS 3 contains also other rules and specifications that deal, for example, with contingencies, cost of acquisition, acquisition achieved in stages, and many disclosures about the business combinations. The second important standard arranging consolidation process is IFRS 10 Consolidated Financial Statements. Let's take a look at its rules. So IFRS 10 rules were a part of the standard IAS 27 since 2001, and at that time IAS 27 covered both separate and consolidated financial statements. And then there were a few changes in IAS 27 and a major revision and change took place in 2011 when IASB issued a new standard IFRS 10 dealing solely with consolidated financial statements. This standard applies from 2013 onwards. The objective of IFRS 10 is to establish the rules on how to prepare and present the consolidated financial statements when you control one or more entities. And in order to meet this objective, IFRS 10 first sets the requirement. So if you control one or more other entities, then you must present consolidated financial statements. There is other very clear video explaining all the terms available on this channel called Introduction to Consolidation and Group Accounts, so check that out. IFRS 10 also defines control, sets the whole guidance about it and how to determine whether there is control or there is not control. IFRS 10 also sets out the accounting requirements for the preparation of consolidated financial statements and outlines the procedures you need to follow. And also IFRS 10 defines an investment entity and sets out an exception to consolidating particular subsidiaries of investment entities. Let's take a look at control first. An investor controls an investee when it is exposed to or has rights to variable returns from its involvement with the investee, which will be a subsidiary in this case. And this basically means that you are not receiving a fixed return, such as coupon or preference dividend, but you can receive dividend from profits or nothing if subsidiary makes loss. Then an investor has the ability to affect those returns through its power over the investee. And the focus here is on power. And IFRS 10 defines it as the existing rights that give the current ability to direct the relevant activities of the investee. Relevant activities are those that substantively affect the investee's return and may include, for example, purchasing decisions, research and development, and so on. The existing rights must be substantive, so the holder must have the practical ability to exercise that right. The investor must have a current ability to exercise these rights and not some potential ability in the future. IFRS 10 suggests that more than one factor need to be considered, and also there is a whole guidance in IFRS 10 about the control, its existence and non-existence under various circumstances. Except for the control, IFRS 10 speaks about the consolidated financial statements, and these are defined as the financial statements of a group presented as those of a single economic entity. So basically, we take the separate financial statements of a parent, then the separate financial statements of a subsidiary, and based on these statements, we can make a group consolidated financial statements. And it means that you need to perform certain consolidation procedures, and they are not a simple addition of two numbers. All these procedures are prescribed by IFRS 10, and except for these procedures, IFRS 10 sets the accounting requirements that you must apply when making consolidated financial statements, for example, about uniform accounting policies, different reporting dates, inclusion and exclusion of subsidiary from consolidation, presentation of non-controlling interest, changes in ownership interests and other. Again, you can all learn that on cpdbox.com. Let me briefly describe the consolidation procedures required by IFRS 10. Step number 1, combine like items of assets, liabilities, equity, income, expenses, and cash flows of the parent with those of its subsidiaries. And combine means simply add up. Step number 2, we need to offset or eliminate carrying amount of parent's investment in a subsidiary with parent's portion of equity of each subsidiary. Step number 3, offset or eliminate in full intragroup assets, liabilities, equity, income, expenses, and cash flows relating to transactions between companies in the group. Because from the point of view of external users to the group, there is no transaction. That's the basics, and there is a nice video with a simple Excel example illustrating these procedures on this channel, so check that out. Finally, let me brief you about IFRS 10 exception related to investment entities. IFRS 10 sets several exceptions, or parents who do not need to present consolidated financial statements, and investment entities are one of them. So what is an investment entity? It's an entity that obtains funds or money from one or more investors for the purpose of providing those investors with investment management services. Its business purpose is to invest funds solely for returns from capital appreciation, investment income, or both. And it measures and evaluates the performance of substantially all of its investments on a fair value basis. IFRS 10 provides a guidance on how to determine whether the entity is investment entity or not, so you might need to check it in the specific circumstances. The main 4 characteristics that the company is an investment entity are that it has more than one investment. Then an investment entity might have more than one investor. It's not the condition, just the characteristics. And also it has investors that are not the related parties of an entity, well, other than having direct shares there. And finally, it has ownership interests in the form of equity or similar interests like shares and not debt. And these are just characteristics or indicators, and even if the opposite is true, the entity can still be classified as an investment entity, so you must assess each case individually. Now, you know the basic rules, so let's apply them. Let's start with the basic consolidation example, step by step. Mami Corporation purchased 80% shares of Baby Limited a few years ago. So here it's clear that Mami is a parent and Baby is a subsidiary, and no, the names are not coincidence. I just wanted you to remember well who's who. Below, there are statements of financial positions of both Mami and Baby at 31st December 2004. Prepare consolidated statement of financial position of Mami Group at 31st December 2004. Note, measure non-controlling interest at its proportionate share of Baby's net assets. All retained earnings of Baby are post-acquisition. So this is one very, very basic example, and we will solve it in a very straight and clear manner. We'll do it step by step, exactly as described in the standard IFRS 10 Consolidated Financial Statements. I always recommend that you draw a nice scheme of a group, some sort of a group chart, even if it seems simple in this case, but that graphic illustration will help you understand what's going on. So we have a baby here, mommy here, and this arrow indicates that mommy owns 80% of baby. And the remaining 20% are owned by other shareholders, and we call them non-controlling interest. The first step is to combine like items of assets, liabilities, equity, income, expenses, and cash flows of the parent with those of its subsidiaries. So let's do it. Here it's obvious that both balance sheets or the statements of financial position have the same format, the same line items, so it's quite easy to add everything up line by line. In reality, a parent can use format of the statement of financial position different from its subsidiaries one, and that's exactly the reason why subsidiaries prepare all those consolidation packages at the reporting dates to bring that into the same format, right? Step number 2, we need to offset or eliminate carrying amount of parent's investment in subsidiary with parent's portion of equity of each subsidiary and recognize any non-controlling interest and goodwill. So we'll do this eliminating entry in the separate column. Just a side note here, for the sake of simplicity and illustration, and make all debit entries with plus and all credit entries with minus. And you can know the same with assets, they are plus, and liabilities and equity are minus. So we credit mommy's investment in full. We insert minus 70,000 here. Then we debit baby's share capital in full. So plus 80,000 here. And yes, consolidated statement of financial position will show only the share capital of mommy and 0 for baby, even if it's not owned fully by mommy. Okay. Now we have other components of baby's equity that do not belong to the mommy group, and we need to eliminate them. Here we only have retained earnings of 45,000 currency units, and they are all post-acquisition. The question said so. Please always differentiate between pre-acquisition and post-acquisition retained earnings of a subsidiary because they are treated differently. But here we focus on basics only. So we need to eliminate a part of baby's post-acquisition retained earnings too. What part? Well, 20%, because that belongs to the other shareholders. Mommy owns just 80%, so we debit retained earnings with plus 20% times 45,000, which is 9,000. And finally, we need to recognize non-controlling interest, and those are exactly the other shareholders of baby who own remaining 20%. Let's calculate it here below in a separate note or working. We applied method 1, so we need to calculate non-controlling interest as a proportionate share in baby's net assets. Method 2 would be at fair value. So baby's net assets are 125,000, which is baby's equity. Non-controlling interest share is 20%, so the amount of non-controlling interest is 25,000. And we can bring this amount to our entry as minus 25,000. This is the equity component, and that's why it's minus. But when you look here below to our checksum, the entry is still not balanced, and it means that there might be some goodwill. So let's check it here. It's calculated as fair value of consideration transferred. Here the mommy's balance sheet, it's a cost of investment in baby, 70,000. Add non-controlling interest at acquisition date, which is 20% of baby's equity at the acquisition date. So it's not the same non-controlling interest as above, because above there's the current non-controlling interest at the reporting date. And here we always calculate goodwill at the acquisition date. Now, as all the reserves or baby's retained earnings are post-acquisition, then at the acquisition, baby had just share capital of 80,000, and 20% of that is 16,000, and that's non-controlling interest at acquisition date measured by the proportionate share. Finally, we deduct baby's net assets at acquisition, again, just share capital of 80,000. And when we add this up, the goodwill is 6,000, and we need to recognize it as intangible asset, goodwill acquired in a business combination. And also then you would have to perform annual impairment test, but we're not going to do that in this example. So see, our entry is balanced. Checksum below, table shows 0, that's okay. Step number 3 is to offset or eliminate in full intragroup assets, liabilities, equity, income, expenses, and cash flows related to transactions between companies in the group. Because from the point of view of external users to the group, there is no transaction, it's one entity only. So when you look here, mommy had a receivable to baby amounting to 8,000, and baby has a payable to mommy amounting to 8,000 too. So how do we eliminate it? We simply debit payables with 8,000 and credit receivables with 8,000. And so the last column is mommy group's consolidated statement of financial position. And I simply add the combined numbers with the adjustments exactly as before. Now look, mommy's financial investment in baby is 0, and so is baby's share capital. Great, that's okay in the consolidated financial statements. Group retained earnings show some strange figure now because this is not simple addition of mommy plus baby. Let's take a look to working number 2 to check that. So group's retained earnings should be equal to mommy's retained earnings of 62,000, mommy's share on baby's post-acquisition retained earnings, which are full retained earnings, and that's 80% of 45,000, which is 36,000. Add it up and you get 98,000 exactly is in our consolidated balance sheet. Everything else in that balance sheet makes sense. Non-controlling interest is 25,000 as we calculated below. Goodwill is 6,000, that's okay. And other balances seem fine too. Now, this was a demonstration of a very simple case study or example and very logical way of doing the things. If you are sitting the exam, you would usually do it in a different style. You would just calculate everything in workings, as I did here below, and you would simply enter these numbers to consolidated statement of financial position without all those columns. So this is okay, and it's up to you. But let me warn you, this is wonderful for the exam. It's not so wonderful in the real life. Why? Because there are many more transactions, and if you want to calculate consolidated retained earnings, just as an example, then you can easily forget something, and as a result, the numbers would not balance. So I prefer doing it this sort of accounting way. After mastering the basics, let's take a look at a bit more complicated scenario when a subsidiary has a different functional currency than its parent, and we need to apply yet one more standard, IAS 21. Again, this example is step by step. Mommy Corporation, established in the United Kingdom with functional currency of British pounds, acquired a German subsidiary Baby Limited, functional currency euro, on 1st January 2001, when the retained earnings of Baby amounted to 4,000 euros. On 30th November 2002, Mommy purchased goods from Baby for 5,000 euros. Mommy sold these goods to external customers by the year end, but its payable to baby remained unpaid. Prepare consolidated statement of financial position as at 31st December 20x2. And then we have further information in tabular form. So we have a table of exchange rates, British pound to euro at different dates. And even we have some average rates for the individual years. And then we have statements of financial position, balance sheets of both mommy and baby. And then we also do have statements of profit or loss of both companies. So I named them mommy and baby on purpose for you to remember who is a parent and who the subsidiary is, right? And let's take a closer look. As you can see, statements of mommy are stated in British pounds and statements of baby are stated in euros. And that implies that we will have to translate at least one of them to the presentation currency, because you cannot really add up balances in euros and British pounds. That would be nonsense, and you know it. So let's say that the presentation currency here will be British pound, which is a functional currency of mommy. So we will only translate baby statements to British pounds. Well, the presentation currency can be anything that presenter chooses, but let's keep it simple here. The second thing is that there was an intragroup purchase of some goods from baby by mommy, but the goods were sold by the year end, which is great because we do not need an adjustment for unrealized profit. All profit is realized because the goods left the group. However, we have unpaid payable of mommy to baby at the year end, so we will have to eliminate it in the consolidation process. But first, let's translate baby to British pounds. We have a bunch of exchange rates here at different dates, and so let's see what IAS 21 says about translating balances to presentation currency. Here, the very important fact is whether the foreign operations functional currency is in hyperinflationary economy or not. So let's deal with our case when it's not hyperinflationary. Well, at least not at the time of publishing this video, right? Who knows what happens? Again, it depends on what items we're translating. All assets and liabilities, including goodwill and fair value adjustments, are translated using the closing rate at the date of the financial statements. Yeah, that might sound strange, as you always heard that you should use historical rate for property, plant and equipment, but just remember what you're doing. We're translating the whole balance sheet to presentation currency. We are not translating individual items to the functional currency. If that's not clear enough, please watch our video with summary of IAS 21 here. Income and expenses are translated by the transaction or historical rate, but it can be impractical to translate each transaction separately, so the average period rates can be used. In relation to equity items like share capital, share premium, and other items, IAS 21 is silent, and the rates to use are not specified here. The most appropriate seems using historical rates, but I have seen the usage of closing rates too. Anyway, it does not have any impact on the overall equity. Why? Because all resulting exchange rate differences shall be presented in equity as a separate component called CTD, or currency translation difference, or in some other way as appropriate. Anyway, in this example, I will tell you exactly what I am using and why. You can use otherwise, but please be absolutely consistent. Now, the last point. When there is a currency of hyperinflationary economy involved, then you should firstly restate the financial statements in line with IAS 29, which is financial reporting in a hyperinflationary economy, and only then apply the same procedures as described, but we're not going to apply that here. So let's work. we have this nice balance sheet in a very simple format without subtotals to make it just totally simple. The first thing you want to do here before we start consolidating these two balance sheets is, as I already said, translate baby's balance sheet to British pounds, and we're going to select which rates to apply. So with assets, it's very easy. You simply apply the closing rate, as we explained earlier in the requirements of IAS 21. And here I do recommend splitting the trade receivables of baby into two parts, outside the group and intra-group, because it will be easier to eliminate. However, both of them are translated using the closing rate, okay? Now, let's take a look at equity and liabilities. And let's do liabilities first because they are easier. And so we have bank loans and trade payables in baby's accounts. They don't look like intra-group, so we just put closing rates here. Here also, I recommend splitting mommy's payables into intra-group and outside the group to make it easier to eliminate. So the question said that there was an unpaid balance of 5,000 euros to baby, but mommy reports in British pounds, and so we may reasonably assume that mommy has already recalculated all foreign currency balances with the closing rate as required by IAS 21 rules for translating into functional currency this time. Careful about that. So these 5,000 euros are shown in British pounds as 4,281, translated by the year-end rate. Now you may say, but mommy would show some foreign exchange gain or loss on that payable because it changed over time. And as it is within the group, it should have no impact on profit or loss, right? At least not on consolidated profit or loss. Well, that's not true because this is the effect of international trading and it will almost never be zero, right? Even in the consolidated financial statements. But let's get back. The remaining balance of the mommy's payable must be outside the group. But back to baby. So equity. This is the hard part because, as I've said, IAS 21 is silent about it. And yes, there was a proposal to translate the equity items at the closing rate, but it was not included in the standard. And so it means that in most cases, companies decide whether they apply closing rate or historical rate. But again, they need to be consistent. So here, let me describe my preferred method, although I saw the other methods too. I prefer to split equity items and analyze them according to the moment when they arose. So let's go one by one. Share capital. To me, the most appropriate seems to apply the historical rate applicable at the date of acquisition of subsidiary by the parent. So this would be 1st January 2001, and not historical rate applicable when the share capital was issued. You will thank me for that a bit later because you will see it will make it easy at consolidation. Then we have retained earnings of 31,000 euros. Now, not surprisingly, we will split the retained earnings into a few parts according to the moment when they arose. The same principle as with share capital and other items. So the first part of 4,000 euros were pre-acquisition retained earnings. What it means, baby was running a company when mommy acquired it on 1st January 2001 and mommy effectively purchased this part. And therefore we need to translate this part with the same exchange rate as applied to share capital because this part will be eliminated later and normally it enters into goodwill calculation. Again, go back to basics if you're not familiar with that. If you remember, acquisition happened in the beginning of the year 2001, and so retained earnings of baby must have increased by the profit for 2001 and the profit for 2002. By how much? Well, let's work with what we have. So here we have the profit or loss statement for 20x2, and we can see the profit of baby for 20x2 amounts to 15,000 euros. So we can bring this up here. And the remaining part of 31,000 less 4,000 less 15,000 must be the profit for 20x1. And this equals to 12,000. Now, how to translate these two parts? Well, I recommend, for the sake of keeping the equity consistent, to translate profit or loss items first and then bring the resulting amount to the balance sheet. It's all about the consistency and presentation, because the amounts will not be obfuscated or hidden by the foreign exchange differences that much. Okay, so we do not have a profit or loss statement for baby for the year 20x1. So let's just assume that all the items were translated with the average rate as a reasonable approximation. So we simply use the average for 20x1. In reality, I do recommend simply taking the foreign currency balance of 20x1 profit in here. For 20x2, however, let's analyze. You should normally use the transaction date rate, if possible, but you can use average rate as the approximation. Again, my recommendation is to apply transaction date rates to all intragroup transactions, especially if they are rare, one-off, big, etc., because it will be clean and easy to eliminate them. Of course, this is not always possible, especially when there are loads of daily intragroup transactions occurring. So you would use the average, unless you have some system in place. But let me use the transaction date rates now. Again, be reasonable here and use transaction dates for any material transactions. To the remaining items, we apply average of 20x2. And so, let's translate baby's balances from euro to British pounds using the rates that we selected. Skip profit for 20x2 and do the profit or loss first. Right. So baby's profit is 12,451 British pounds, and we can take it in the balance sheet up there. Fine. Now, what can you see? Baby's assets in British pounds are not equal to baby's liabilities and equity. Of course they are not. You use different rates to translate. So this difference is called currency translation difference, or CTD, and it is a part of equity. And actually you can calculate exactly where this came from. Here in this case, it is quite material, significant, over 9,000 British pounds, but not surprisingly, just look at the volatility of exchange rates of British pound to euro, and you see that British pound went down significantly against euro in 20x2. And let me tell you a secret now, these rates are real. I took them from 2015 and 2016, and guess what happened in 2016? Yes, Brexit referendum, where British people voted out of European Union, and as a result of that decision, British pound weakened quite significantly. This graph is not ideal because it shows the rate euro to GBP, not GBP to euro, and this is why you can see the different rates inside of this table. But I selected this period on purpose to show you how the group can benefit from movements in foreign currencies over time just by owning a foreign currency asset, a subsidiary. This time, well, the things can go the opposite way too. Just be careful about that. So from now on, you're all set, and you can continue with basic consolidation procedures that will be fairly easy this time, since there will be no goodwill, no non-controlling interest, simple consolidation. So first, you need to combine mummy's and baby's balances, both in British pounds this time. Then we will perform the elimination entry to get rid of mommy's investment in baby on one side and baby's share capital and pre-acquisition profits on the other side. And you can see that it's fairly easy thanks to using the historical rates at the date when mommy acquired baby, because that's also the rate at which mommy recognized its investment in its own financial statements. We also need to eliminate intragroup balances, the receivable of baby with payable of mommy. And here we will focus only on the balance sheet. We are not consolidating statement of profit or loss. But if you are, you also need to eliminate intragroup balances, their revenues and cost of sales, and eventually make an adjustment of unrealized profit, but not this time. Finally, add up the numbers of steps 1 to 3 and you're done. You can play around with some numbers to show nice numbers, subtotals, or whatever you need to do, but you are done with the basic consolidated statement of financial position in foreign currencies. This file will be available on my website too. All right, now let's take the things even further. In the next lecture, I will teach you to prepare the consolidated statement of cash flows when foreign currencies are involved. Many companies do it wrong, so don't make the same mistake. So how do the most companies prepare their consolidated statement of cash flows? Normally, you take the consolidated balance sheet or the statement of financial position, that's FP letters, profit or loss and other statements, and then you calculate year-to-year changes in the assets, liabilities, and equity items. So you take closing balance less opening balance and you have a change. Then you put or classify these changes into the statement of cash flows. You make some non-cash adjustments like depreciation. Then you eliminate intragroup cash flows and transactions and you're done. Nice and easy method, and I must say that in the exams this method is usually examined. Now, this method is okay, but only when no foreign currency is involved. In other words, parent and subsidiary use the same functional currency. So if you operate in the UK and you have a subsidiary in the UK, then use this method and you'll be just fine. This method is not okay when a parent and subsidiary use different functional currencies. For example, parent in the UK using British pounds and subsidiary in Germany using euros. Why is this method wrong in this case? It is not in line with the standard IAS 7 statement of cash flows. Why? Well, because when you're preparing the step 2 and calculate the changes in balance sheet items, you are effectively applying the closing rates because subsidiary's financial position was translated with closing rates. However, IAS 7 prescribes using transaction date rates for your cash flows or average rates. If you use the wrong rates, then also your numbers are wrong and it becomes evident when there's a high increase or decrease in foreign exchange rates over time. So how to do it instead? What's the right way? Okay, let me show you on a short example. So here it is. Hello, the UK company has owned 100% in Gutentag, a German subsidiary since January 2015. The following transactions occurred in 2016. On 31st October 2016, Gutentag paid dividend of 1,000 euros to Hello. On 30th November 2016, Hello purchased goods from Gutentag for 5,000 euros with cost of 4,500, that's cost of Gutentag. The goods remained unsold at year-end and the payable was unpaid. The applicable rates and financial statements are below. Prepare the consolidated statement of cash flows for the year ended 31st December 2016. How shall we start? The step number 1 is to prepare the individual statements of cash flows for both parent and subsidiary and ideally use the same line items. Well, I have prepared them for you. I'm not going to teach you in this video how to do that because I published an article with video about the detailed method on ifrsbox.com, so please check that out. We have a nice clean individual statements of cash flows here. Hello in British pounds and Guten Tag in euros, so both in their own currencies. Step number 2, we need to translate subsidiary statement of cash flows to the presentation currency, and in this case we assume it's going to be the parent's currency, so we translate euros cash flows to British pounds. What rates do we use? Where possible, we use the transaction date rates, otherwise average period rates. We can use the transaction date rate for dividends paid by Guten Tag to Hello, that was on 31st October, so we use 0.9005. Then other items are translated with average rate in 2016, 0.8188. By the way, these are the real rates. And what about profit before tax? Here, be careful, and I recommend not applying any rate in the statement of cash flows, but I recommend taking this number from the Guten Tag's individual profit or loss statement translated to British pounds. The reason is that in that profit or loss statement in British pounds, there are Guten Tag's numbers translated with different rates, not just with one rate, so we need to translate profit or loss too. Let's see. We can translate intragroup sales of 5,000 euros with the rate on 30th November, that's when the sale was made, and remaining items with the average rate. Then Guten Tag's profit for the year is just calculated from British pounds numbers, and it is transferred or brought to the statement of cash flows. So no rate is applied in the statement of cash flows. It is taken from individual statement of profit or loss translated to British pounds. Back to the cash flows. Opening and closing balances of cash are translated with the closing rates of 2015 and 2016 because these are not cash movements, cash receipts or cash payments. These are the balances at the year end and must come from the balance sheet. Now, there's a checksum. It checks whether your numbers are correct and it should be 0. Here it's not 0 because we applied different foreign exchange rates to different items, and it's quite huge. It's 2,528. This is the effect of exchange rate changes on cash, and if you are preparing your cash flows with the common method from the consolidated balance sheet, this would be wrong. Why is it so high here? Well, look at the exchange rates. They are real rates, as I mentioned. At the end of 2015, it was 0.734 British pounds for 1 euro. At the end of 2016, it was 0.8562 British pounds for 1 euro. So British pound weakened in 2016, and most of this foreign exchange effect represents the effect on cash balances. Now, it's possible to prove this number, and it's not the same as currency translation difference in balance sheet. But we will not do it in this video. The step number 3 is to aggregate parents' and subsidiaries' cash flows. Easy, you just add up Hello's line items and Guten Tag's line items in British pounds. Step number 4 is to eliminate intragroup transactions, and this is the most demanding step that takes a lot of work, but well, we have to do it. And you need to be careful with rates at which you eliminate. Think about what rate was applied to include the item in the financial statements and eliminate with the same rate. Well, let's see. Here we have 3 things to eliminate. The first one is dividend paid by Guten Tag to Hello. We will eliminate the dividends from the affected captions, which are profit before tax. Parents' profit was increased by the dividends, so we must bring it down, we deduct. Then the adjustment for finance income and expenses net. The net expenses were added, but they were lowered by the dividends paid, so we must increase them again, add the dividend back. The dividend received, no dividend was received by the group, so deduct, and dividend paid, no dividend was paid to the group, add back. The sum of these adjustments shall be 0. We use the same rate for all 4 entries because we assume that the parent recognized the dividend income using the transaction date rate, and the dividend paid in subsidiary statement of cash flows was recalculated using the same rate. Then we eliminate Guten Tag's receivable with hellos payable. If you make cash flows with direct method, then this specific item is not necessary, but under indirect method, yes, you need to do it. So how do we eliminate? Subsidiary Guten Tag has receivable of 5,000 euro to the parent, and this affected the increase of trade receivables line. Without this intragroup receivable, the decrease would have been lower by 5,000 euro, so we add this amount back. What rate? Well, subsidiaries' cash flow statements were translated using average rate, so we translate the elimination in the decrease with the average rate too. So we add back 5,000 times 0.8188, which is 4,094 British pounds. The parent Hello had an intragroup payable of 5,000 euro. This affected the decrease in trade payables line. Without this intragroup payable, the decrease would have been higher by 5,000 euros, so we deduct this amount. What rate? Parent's cash flow statement was prepared from its balance sheet, and the intragroup payable was translated by the closing rate there. So we deduct 5,000 times 0.8562, that is 4,281 British pounds from the line decrease in trade payables. Now our checksum shows the difference of 187 British pounds. It's here because we apply different exchange rates, and therefore you need to report this amount in the line effect of changes in foreign exchange. Finally, let's remove the unrealized profit on inventories and its impact on the consolidated cash flow statement. Subsidiary made profit of 500 euros, it's clear from the question. And inventories are still in the Hello's warehouse, so there's no profit for the group. How do we eliminate? Subsidiary Guten Tag made profit of 500 euros and reported it in the line profit before tax. So we need to deduct 500 euros from that line. What rate? In subsidiaries profit, intragroup sale was translated using the actual transaction date rate, so we need to use the same rate when eliminating unrealized profit. By the way, AUP means adjustment for unrealized profit. We deduct 500 euros times 0.8525, that is 426 British pounds from the line profit before taxation. Then, parents' inventories are overstated by the unrealized profit of 500 euros, and it affected the line increase in inventories. Without this profit, the increase would have been lower, and therefore we need to add it back. What rate? Well, UK parent recognized the inventories at the transaction date rate, historical rate. The inventories are non-monetary item, and therefore they remain the same without recalculating them by closing rate at the year end. So we add the same 426 British pounds back to the line increase in inventories. Now the last thing, we add up the aggregated numbers and adjustments, and voila, we are done. You have a nice, clean and correct statement of cash flows here. I know it's a laborious process, but this is the right process. The final part of this masterclass is step-by-step consolidation when a subsidiary is not a business, just some group of assets. Yes, there is a difference, so let's dive in. Mami Corporation acquired 80% share in Baby Limited on 31st December 2002 for 80,000 currency units. After careful assessment, Mommy concluded that baby does not constitute a business and serves only as a carrier of assets. It has no liabilities and all assets are shown at their fair values. Prepare Mommy Group's Consolidated Statement of Financial Position at 31st December 2002. And here we can also see the balance sheet of both Mommy and baby. So looking to Mommy, we see the investment in baby amounting to 80,000 currency units. And when we look to baby, we see no liabilities, only equity composed of share capital of 85,000 and retained earnings loss of 5,000. And that may represent some expenses required to maintain the property, who knows. So this is indeed very simple balance sheet. Usually you would see some cash or bank accounts or small liabilities in there, but for the purpose of this video, we keep it absolutely simple. So before we start with the example, let's actually see what the standards say. IFRS 3 business combinations applies only when an investment constitutes a business, and IFRS 3 contains a guidance on what the business is, but we are not going to deal with it here. So this transaction is out of scope of IFRS 3. However, we have the standard IFRS 10 that requires preparing consolidated financial statements for each subsidiary and even for those who do not constitute a business. Yes, there are some exceptions, but not being a business is not one of them. So you do need to consolidate. How? You're going to apply different procedures from those when you acquire the business, of course. In fact, they are prescribed in IFRS 3, and it asks you to account for such a subsidiary as for an asset acquisition rather than full consolidation. And this means that you need to allocate the cost of the group to individual assets and liabilities of acquired subsidiary based on their relative fair values. And then it also means that there is no goodwill. No goodwill, okay? The thing is that if you paid more than the fair values, this excess is a part of that allocation in step 1, not a goodwill. And we will show that in the numerical example. And finally, if you acquired less than 100%, you have non-controlling interest, and that is always measured at fair value, never at a proportionate share, which is a very common method used when you work on the full consolidation of a typical parent-subsidiary relationship when there is a business involved. So here, non-controlling interest measured at fair value only. So let's take a look at our example. I place the two balance sheets together, one next to each other. And now the first thing what we do is to calculate the cost of the group, which is the sum of the consideration transferred and non-controlling interest acquired, measured at fair value. So Mommy paid 80,000 and that comes here into consideration transferred. What about non-controlling interest acquired? Yes, there is some, because Mommy purchased just 80% share for 80,000 currency units. Therefore, non-controlling interest is 20%. But what is the fair value of it? Well, we don't know, and really you should apply IFRS 13 fair value measurement to measure this fair value. But for the sake of simplicity, let's assume here that Mommy purchased 80% at its fair value of 80,000. So if 80,000 is fair value of 80%, then logically the fair value of remaining 20% would be 20,000. Of course, that might not be the case in reality, because Mommy acquired controlling share and it might have paid a premium amount for the control that would not be included in the non-controlling interest valuation. So please do not assume this is automatic. I am using the simple method here to illustrate. Fine. So the cost of the group is 100,000. We need to allocate it to the cost of assets and liabilities acquired relatively based on their fair values. Okay, so the question said that baby's assets were at their fair values. So let's do the allocation. To investment property, we allocate 70,000 divided by total assets of 80,000 multiplied with cost of the group of 100,000. And this comes to 87,500. And to machines, we allocate 10,000 divided by 80,000 multiply with cost of the group of 100,000. So this is 12,500. Now we can do our consolidation entry. Here the first step is not to combine mommy with baby because those are not the right numbers, all right? Instead, we debit property, plant and equipment with 12,500. This is the amount allocated to the machines. We debit investment property with 87,500. This is the amount allocated to investment property. Then we credit mommy's investment in baby of 80,000 to get rid of that in consolidation. And then we need to recognize the non-controlling interest acquired at its fair value of 20,000 as credit in equity. And we then simply add up mommy's numbers with the entry. And here you go, you consolidated subsidiary that is not a business. Now, we can argue that some assets might be overstated. For example, those machines had fair value of 10,000, but we allocated 12,500 here. So now the carrying amount is greater than its fair value. And to solve this, you should look at the consolidated assets and liabilities and continue measuring them in line with the other appropriate IFRS standards. So for example, here you would need to perform the impairment test because carrying amount is definitely greater than the fair value. So this indicates the impairment. It might not necessarily be there. It could be that the value in use will be greater than the carrying amount of 12,500. So then you're all okay, but you should definitely test. Now, let me just show you quickly how this would look like if baby was a business and you apply the full consolidation method instead. I have worked this example out for you because this is a typical consolidation with goodwill and all that. And I worked this example with applying proportionate share method of measuring non-controlling interest on purpose to make a contrast. So see, I calculated non-controlling interest as 20% of baby's net assets at the acquisition date, which is in fact 16,000 and not 20,000 as valued by fair value before. I could have used fair value too. Then our goodwill acquired comes to 16,000. And you remember that before we did not have any goodwill at all. So let's take a look at consolidation entries. Here we simply added up mommy's and baby's numbers. So you can see that we are taking baby's assets at fair value to the consolidation and not at the allocated cost of group as before. So the investment property is just 70,000 here, not 87,500. Then we have a goodwill here. Before there was none. And here we have non-controlling interest at the proportionate share. It could have been at fair value. I repeat that. That's your choice here. But before you had to do non-controlling interest at fair value. Unless you're liquidating. I need to say this. If you're liquidating, you can use also proportionate share. But unless you're liquidating, you need to apply fair value when accounting for asset acquisition. Now let me put two consolidated balance sheets next to each other. So you see that they look slightly different. And I remind you again, once you're done with asset acquisition accounting, you should review all the items one by one and see if you need some adjustments like impairment tests. Another example, I would say that investment property would need downward revaluation via profit or loss because this is definitely stated over its fair value of 70,000, okay? So this is it, the absolutely simplistic example of consolidation when acquired subsidiary is in fact group of assets, not a business. If you made it here, well done. I hope you got a great starting point, but there are more nuances to cover, like statement of profit or loss, sales and purchases within the group, dividends, and other transactions. So again, please, if you're serious about your IFRS knowledge, check out the IFRS kit on my website. Thank you for watching. Like this video if it helped. Subscribe to this channel for more. Bye.